Hey guys, welcome to another episode of Spilling the Beans. Today I'm up in Cleveland at the Bratz Manor. This is our office building up here, and we got a bunch of people coming in this week for both filming of Legacy Wealth Academy. And by the way, if you're not part of Legacy Wealth Academy, you need to be. It's like $9 a month, and there's these master classes on all things wealth. And we also have a mastermind going on this week. But anyways, a bunch of awesome people coming in town. One of those is Joe Viery, who has U.S. Tax Advisors Incorporated. They're out of California, but they do business all over the country, specifically for cost segregation and for tax credits, energy efficient tax credits. And so I'm gonna be sitting down with Joe, talking all things taxes, how to reduce your tax liability, how to capitalize on the tax code, and really wrap our heads around what is a cost seg and what can you do with it, how can it benefit you as an investor. So let's go sit down with Joe. Joe, welcome to Spilling the Beans, dude.
Tim, it's great being here.
Hey, man.
Love it.
Good stuff. Well, you're in Cleveland. You're filming for Legacy Wealth Academy, creating a course for that. So I want to dive into that. But I think it's important to understand full, all-encompassed what you guys do at U.S. Tax Advisor Group. Talk a little bit about that, a little bit about your entrepreneurial journey. How'd you end up doing cost segs and tax advisory type stuff?
Great. So you want to start with the beginning?
Yeah, man.
Let's start at the very beginning.
Yeah.
Okay, now I'm going to try and make this as clear as mud. But bottom line is I've been in the entrepreneurial mode since college.
Okay.
So I went to high school. As a senior, we went to Europe, me and my family, cousins, and we did the backpacking. Now fast forward to I was a junior in college, and there was a travel day on campus, and I saw the guy that helped me go to Europe, backpacks and charter flights, and I started talking. Everybody wants to talk about travel, and at the end of the conversation I said, oh, by the way, do you have a job? I'm looking for a job. He said, why don't you come and talk to me tomorrow? So I went out to his place, and I asked him about the opportunities for work, and he goes, well, I'm starting a travel agency. He goes, I'll train you to be a travel agent. Would you like that job? I said, yeah, I think I'd love that job. So I became, this was back before computers. This was the dark ages.
Yeah.
So we had to learn how to, airfare construction and all this horrible stuff. I hated it, and I asked my manager, I said, why are you doing this? She goes, well, I'm not doing this to be a travel agent. I'm in the industry because I love group travel. And I said, group travel, tell me about that. So she told me about group travels. I said, how do I do it? She goes, well, you have to sell a couple groups or groups. So I went out and I sold a group of avocado growers going to South America and a group of Portuguese people going to Portugal. And I came back from both of those experiences and I go, that's what I really want to do. So I interviewed with a company and to be a tour manager. And I went with a full... Did
you go with both of those groups?
Yes.
Oh, okay.
And I loved it. I was like, this is what Joe, I love this job.
Yeah.
It was a blast. It was so much fun. And it was very creative and a lot of responsibility. I just loved it. So I came back, and I only wanted to work for one company because they were super deluxe and they had both international and domestic tours. So bottom line is I drove up to LA with my leg in a cast. I got interviewed. The guy goes, hey, I really like you, but I can't offer you a job. So I drove back down, no problem. 3 weeks later, he called me and says, I changed my mind. I'm going to give you a full schedule. So when I did the schedule, it was 6 weeks on, 1 week off. Well, when you're a young man and you're away from your woman for 6 weeks, that's not going to work. So after doing this for a couple of years, I said, okay, this is not going to work. Now what do I do? And I said to myself, start your own travel company.
Yeah.
And you can go when you want, wherever you want. So I started my own business, and I did that for 20 years. And I had accounts, the San Diego Chargers, TV stations, radio stations, insurance companies, and I traveled all over the world. I ran my own successful travel company, and in 2000, changes happened in the travel industry. I sold, and I went, I was a business management major, so I went into quote unquote business, and I worked for the California Association of Realtors.
Okay.
And while I was with CAR, I sold investment strategies and tax reduction strategies to both members and to their clients. Now 2007 comes along, and the car that was on the cliff went over the cliff and crashed, and I'm with the California Association of Realtors, which their total membership was cut in half.
I was gonna
Everybody
say,
quit.
It had to be at least 50 to 75%, right?
Nobody was selling
Yeah.
real estate. It was horrible. So basically, that job is over. I mean, forget about it. Well, a year before that, a friend of mine kept wanting to talk to me about the strategy. And I thought he wanted to sell me Amway soap. So I kept blowing him off. So finally I said, okay, Mike, let's go to lunch. Tell me about this strategy. Well, he told me about cost segregation, the acceleration of depreciation. I had two clients that were staring down the barrel of 50,000 plus in income taxes. I got them all set up. They were thrilled with it. So when the car went over the cliff and the California Association of Realtors in the real estate industry was dead, the owner of the company that I used called me up and said, Joe, you're great at this. Why don't you come work for me? So I said, definitely. So I segued. I started working in cost seg. And what I found, I was really, maybe I made my own luck, but maybe I was lucky, is that the clients that I attracted when I first started were those with lots of cash in their pockets. Why was that lucky? Because while everybody was selling and dumping, they were buying. So they would loan a hotel money, the hotel owner couldn't pay the money back, so they took over the hotel. And so I had a lot of clients set up like that, so I didn't start slow, I started like that, and I've not stopped. About 7 years ago, I started U.S. Tax Advisors Group, and it's a group of engineers that put together cost seg studies and energy, 45L energy studies. And so I've only known entrepreneurial type of work. I've only been my own boss, so I really do appreciate that your group and Legacy, they're all entrepreneurs.
Yeah, man. It's the exciting part, right? Like, it's fun to hear the backstory of how people became entrepreneurs. Some of them were forced into entrepreneurship because they lost their jobs. Other people were unemployable since the time that they came out of the womb. You know what I mean? Like, it's very interesting to see how people become entrepreneurs, and things that many times they think are setbacks in their life are actually setups for entrepreneurship and doing better things and having a better lifestyle or making more money and building more wealth and making a bigger impact, which is, I think, pretty cool.
I love hearing those stories. Everybody's unique, they're different, and the Legacy Group, I could listen to their stories of how they got started all day long.
Good people, good people. So let's talk about cost segregation. So specifically, I want you to explain cost seg to me like I'm a third grader.
Yes.
And then I want you to explain, like, what does the tax code look like and how does it benefit and who would it benefit?
Great. Okay, you have great questions. So first of all, I'll make it super, super easy. Everybody knows what gross taxable income is. You have gross taxable income, and that's what you pay your income taxes on. Whatever your tax rate is, it doesn't make a difference, but let's use 30%. So if you have gross income of $100,000 and you have a 30% tax rate, you're gonna write a check out to the IRS for $30,000.
Right.
Okay, now, to reduce your gross taxable income are expenses. That's why everybody's in real estate, because real estate offers some very great tax strategies out there. So for example, you could write off your interest, right? One of them is depreciation. Now, what is depreciation? What the IRS says with depreciation is that throughout ownership of the building, your building is falling apart. It is deteriorating. So what they're allowing the owner to do, rather than wait until they have to fix it up or do improvements, they're saying, look, we're going to give you a depreciable write-off, an expense against income, and it's the most common is called straight line. So that's really easy to calculate. You take the building acquisition cost less the land, and you come up with your building basis. If it's residential, you divide by 27 and a half years. If it's commercial, you divide by 39 years. So as you can see, you're getting a very small write-off.
So let's do some math on this.
Okay.
So we buy a single-family rental home, right? If somebody buys a single-family rental for $100,000,
let's say 120.
$120,000, because I assume there's $20,000 in land value.
Exactly. Math is easy.
Yep. And you cannot depreciate land.
Correct.
Right? Land has always been here. It's always had value. You can't but you can depreciate the building value of a property. So you're saying $120,000, $20,000 of it is the land value. Is that typical? I guess it depends on where you are, because I live on the beach in South Carolina, where the land value is, for my house, is $4 million, and the property value is probably $2 million,
Yeah,
you know?
and that's common. California, Miami, Florida, New York City. Obviously, you're not going to have 20%, but 20% is what we use as a standard nationwide. If somebody doesn't know their land value, I'll just say let's use 20.
Let's ballpark
and then we're not land appraisers, so you have to come up with the land allocation, but I can give you tips. So let's keep going with the math.
Would you look at like the tax assessed value and see what they value it at, like as a percentage of the property?
I have a whole litany of strategies, but the
So that way
IRS...
it's not totally on the landowner or the property owner who doesn't really potentially know?
But here's the key. The IRS loves the county tax assessor. So that's what we tell everybody, go there first. Now, if it's crazy high, like you're in Cleveland and the land comes up at 50%, I would say don't use that. Let's go to another strategy. And another strategy is you pay for an appraiser. That I don't recommend. I've been doing this since 2007, and I've done so many studies, I can't even throw a number out, probably 20,000. And I've had 2 people that paid an appraiser to appraise their land value. So there's other strategies out there, but let's just say the county tax assessor uses 20%. So there you go, 20% or $20,000
Let's
on the
call it
120.
20.
Yep.
So now you got $100,000 of building value. You would, because it's residential, you would just divide by 27.5, 27 and a half years. Mm-hmm. And that's how much depreciation you get every year for the next 27 and a half years.
Correct.
Right? And so the difference when you talk about a cost segregation study is you're segregating, you're pulling out certain expenses because there's certain parts of the property that actually depreciate faster than 27 and a half years. Right?
Correct.
Like water heater doesn't take 20, like you're gonna have to replace that probably multiple times in 27 and a half years.
Correct.
The roof might last 30 years, but maybe not, right? What about the trim? What about the carpet? What about a lot of those things? So explain what a cost seg does in that regard.
There are hundreds and hundreds of components. The IRS, through time and court cases, have ruled that they have shorter lives. So let's use the very obvious one. If we were sitting in a hotel right now and I pointed at the carpet and I said, is that carpet going to last 39 years? You'd think I was crazy. Hell no, it's going to last maybe 5 years, maybe 7 years.
And the reason that he's saying 39 years is because a hotel is a commercial property. Commercial's depreciated over 39 years,
Over
right?
39 years, exactly. Or even if it's a multifamily, it's not going to last.
Anything 5 units and bigger would
How
be
long?
commercial.
You tell me, how long would a carpet last in a multifamily?
We don't use carpet anymore because it
there
doesn't
you
last
go.
very
Okay,
long.
it doesn't last very long.
Yeah.
Okay, so basically that makes sense. So you see that the IRS has given shorter lives to all kinds of components, and the job of the engineer is to determine what could be inside the building 5 or 7 years, and then the land improvements is 15 years. So now you've got 5, 7, and 15, and by
everything can be put under that umbrella, under one of those?
Or finally, the biggest bucket is always going to be in real property, which is still 27 and a half year or 39 years. So for example, we're leaving a big chunk of that asset in long term, so you're not getting rid of the depreciation. You're just peeling off the 25 to 30 to 40% of it that can be accelerated.
And when they say accelerating the depreciation, that means you can take that depreciation sooner than having to wait to just take a little bit over time. When you take a look at, and I'm going to put you on the spot here for some ballpark percentages based on asset class, all right? Mm-hmm. But when you take a look at a residential property, how much of that can you typically depreciate in year one with a cost seg study? Okay,
so I will tell you this. When we estimate, we're very conservative. I'm going to estimate for that building probably 22 to 25%. The reality, per residential, per single family home. For multifamily, it's going to be higher. But let's use 22 to 25% to be conservative, knowing that when we do the study, we're probably going to be closer to 30%. So if you want what we truly find, it's probably going to be 30%. So out of that $100,000,
that's what I found. I found between 25 to 30% typically.
Yeah. But we like to, the saying, under deliver and over promise, or whatever that is. And we are very conservative.
Under promise, over deliver.
There you go. Thanks.
But here's the power in this though. Is somebody is, actively, or they have a bunch of real estate, or they have a bunch of active income. The key here is if you're a full-time real estate professional, you can take because depreciation is a passive loss, so it can only offset passive gains. Passive gains are things like rental income, dividends, interest income, things like that. Your active earned income, let's say somebody flips houses, well, let's not use that. Let's say somebody's a doctor or a dentist, they make $800,000 a year. You cannot offset that income with your depreciation because you're taking active income and passive losses you can't offset. You have to put only active losses with active income and passive losses against passive income. The difference is if you're a real estate professional, right? This
Correct.
is where the magic happens in the tax code. And by the way, I'm not a CPA. Talk to your CPA about this. Got to put disclaimers and stuff in there. But real estate professionals, because you're flipping houses and wholesaling houses and making fees, if you're a real estate professional, which is designated as 750 hours in the year, which is about 15 hours a week of time, and if that's your primary effort, I guess, then you can become a real estate professional. You just designate that with your CPA. But now you take all your active real estate income and your active losses and your passive income and your passive losses, and they all end up going into the same bucket.
Yep.
So now if you're a full-time real estate professional and you flipped a house and made $50,000 on it, and then all of a sudden you have this other rental property that we're talking about over here that has $25,000 the first year in depreciation, you can cut that tax liability in half because you're offsetting it with the depreciation over here. And it, again, reduces your tax liability, lowers your tax bracket that you're in, and it's a huge, huge benefit if you're utilizing it the right way.
Now, one thing is that we do have a lot of passive investors because you can use passive losses against active income, but they limit it severely. And don't ask me, I'm not the tax professional, but it's anywhere between $25,000 to $45,000 per year. So let's say you have that doctor who bought
it caps out
120.
usually?
Yeah. So let's say you have a doctor who bought 125,000 that single-family home. So they're not going to be able to take, necessarily all of it. But let's even go up higher. Let's say they bought a $400,000 home, and I give them $100,000 in losses. It's only a timing difference. If the max is $25,000 per year, it's going to take them 4 years to run through that $100,000. But they don't mind waiting the 4 years. It's just a timing issue.
Right.
So even if you're passive, I would give somebody a call, like either someone from my company or their accountant, to say, look, I'm a passive investor. Should I do this? If they say no, don't do it.
Yeah, yeah. But it can also offset capital gains. They're going to sell their business. If they're invested in some other properties passively as an investor and they got a big gain from that, or they get dividends coming in from another property or another investment or another business that they might have, and they have an exit on that, they can utilize that depreciation in order to offset some of those gains. So that's powerful. Talk about how the step down's occurring right now, right? Like last year it was 100%.
Yes.
This year is 2023 and it's 80%, right?
Yes.
And then it steps down for the next 5 years.
Yes. So what happened is during the Trump tax law, they gave a very beneficial kick to real estate, and they let you take any property with a life of 20 years or less, you can immediately deduct it, 100%.
So that's real property. That is airplanes, right? That's automobiles over a certain size. That's private jets, helicopters, like things like that. People could buy equipment, buy vehicles, and then depreciate the entire thing in year one. If it's under
bonus depreciation.
Right. And what did you say the caveat was? 20 years of depreciation.
And what did I just tell you we find in COSEG? 5, 7, and 15.
Right.
So everything I find that can be accelerated now is an immediate write-off. So if you're on extension for 22, you're still going to get 100% of the amount. If you file your taxes in 23, that 100% goes to 80%. So you're going to get 20% that is going to follow you over time, over a couple of years. It's just a timing issue. I don't use
you don't lose the other.
No.
Like, all right, so let's give that example.
Yep.
So on the $100,000 house, $25,000, you could do that for 2022.
Right.
Right. But this year, for 2023, you'd only get 80% of that, so you get $20,000 this year. The other 5 would roll over till next year, right?
Roll
so
over
you're
next
not
year, or
losing.
maybe even the next year. Because when I started in this industry, we didn't have bonus depreciation. So it means really nothing to me. It's just a timing issue. So you get 80% of it anyway the first year, and then the trails of the 20% you got over the next 5 years. So you're still going to get it.
Got it. So, and that's the difference. The difference is they just let you front end load it into year 1, because of the Trump tax codes. If and when this all goes away, people can still depreciate and front end load of it. Maybe not get 25% in year 1, but get a larger chunk, substantially larger chunk than 3%, right? If it's depreciated over 27 and a half years.
Exactly, and that's the math.
Right. Makes a lot of sense. So, do you guys do cost segs on and help with depreciation on other assets also, or just real estate?
Just real estate.
Yeah.
Yep.
Because that's the one that's complex, right?
Exactly.
Everything else is less than 20 years, so that's pretty easy for just the accountant to do.
And we do any type of real estate. So don't get caught up in like, oh, but I only own a single family home. We have grown to the point where we do modeling studies, which is an analytical study for buildings with a basis of 750,000 or less. We're not going to fly to Cleveland. We're not going to fly around the country to inspect the building. We can do it analytically. So we do those studies for hundreds of dollars.
I love
so
that.
now anybody with 150,000 single family home can now do cost seg.
That's amazing.
Yep.
Because that was the issue, because people had to travel out there, it was a bunch of expenses, and it would be cost prohibitive on a smaller property.
For a bigger property, I have to charge thousands of dollars because I have to spend 2 days in the field or a day in the field measuring all the building components.
But the reality is, cheap. I bought a $70 million property, actually $77 million property, and I had 20% ownership in it. And because of the cost seg, I personally had almost $3 million of depreciation in year 1.
Yeah, that's huge.
So it's worth spending the money in order to have a cost seg done. Now let's talk about what happens. When does it not make sense to do a cost seg? If you're going to plan on flipping the house and you have to recapture that, explain what depreciation recapture is and how that would adversely affect, or how the tax code's written in order to get past that, or what an exit would look like for somebody who would have a substantial recapture like I'm going to have on that one.
So basically, the depreciation recapture tax is 25% of all the depreciation you've taken since ownership. Okay, so bottom line is it's quote unquote a tax. However, there's one thing I must mention is that cost segregation reduces depreciation recapture if you have the right accounting team that understands cost seg and how to apply the benefits of cost seg. So what do I mean? Think of buying a laptop 5 years ago for $2,000. What is that laptop worth 5 years later?
Nothing.
About $100 maybe,
most,
if you get parts. The savvy accountant, if you've owned the property for 5 years, and to make the math easy, I'm just going to use 5 years.
Yep.
So 5 years later, I've identified the 5-year property. They make the claim to the IRS. There's no value to the 5-year property. We've used it up. There's a little residual value. So maybe if it's like say 20,000, they may say it's worth $1,000, but they're going to not use the full $20,000. They're going to reduce that, and so that reduces your depreciation recapture. A third of the 15-year property is going to stay in the calculation, is going to be discounted off the table because you've had the 15-year property for 5 years. So you're reducing your depreciation recapture. So even though there is depreciation recapture, so
it depends on the timing of when the property sells.
Exactly.
Right. So they're not. So if you bought a property this year and cost segged it and then plan on selling it next year, you're going to recapture a lot of it.
Oh, I'm going to tell you don't do it.
Yeah.
Joe will say
Doesn't make sense.
all of the strategy only works if you're going to hold the property for at least 2 years.
Right. And the reason you would do it is because if you're in growth mode, right? Like I was in growth mode for many years, and I would rather take my tax liability and infuse it into more deals, right? In order to grow the portfolio and continue growing the business as opposed to paying it in taxes. And so it can make sense to reduce your tax liability this year and give you some additional runway to buy some properties for another couple of years. And then even if you sell it in year 3 or year 5, then it can make sense, right? So,
well, let's get back to that question.
Yeah.
There's only in 4 instances where I will tell you it doesn't make sense to do cost segregation.
I'm excited for this.
Okay, and this boils it down crystal clear. Number 1, is depreciation recapture. If you're not going to hold the property for 2 years, don't do it.
Yep.
It's will you get hurt? You're not going to get hurt, but you're not going to get a lot of financial benefit if you're a flipper and you're going to flip the property. So forget that.
Yep.
That's number one. Number two, you're going to think I'm silly if you don't pay income taxes. Remember, real estate has a lot of tax advantages. I have people that call me, they want to do cost seg, and I go, well, how much are you going to pay in taxes this year? And they go, nothing. I go, well, why? You don't want to do cost seg.
Yeah.
Call me when your accountant says you need to write a check out to the IRS. So those are two. Three is if you're involved in a 1031 exchange and it's an even exchange, you don't have any money left over, because what happens when you sell the relinquished property and you put that money into your new property, whatever method of depreciation, it must stay in that method.
Right.
So if it's straight line, that $1 million out of is locked out.
I didn't know that.
But let's say you step up and you buy a $2 million property. Now Joe has $1 million to work with.
Got it.
Then cost seg makes sense. So if it's a
Okay, so
straight,
you would separate out whatever the property came from, however that one. So if I bought this building right here, and I never depreciated it, just left it on straight line depreciation, and then I bought this one that's bigger over here, I could only accelerate depreciation on the basis above what this one was.
Exactly. That's very simple, and the accountant has to get involved. But bottom line, just keep that in mind. If it's a straight exchange, don't bother looking at cost seg. I have nothing to accelerate.
Interesting.
So,
and then what was the fourth one?
Fourth one was a good one, and I can't remember what it was.
It's all good. We'll come back to number 4. Going back to the 1031, is there recapture in a 1031?
You know what? 1031s.
Like if I sell this building and I want to roll it into something else,
No.
but I cost seg this.
No.
They
There's
can't
no
recapture that?
recapture. So you're out of the woods for recapture is if you're doing a 1031 exchange, or the money, or the property is gained in an estate. Someone dies, you don't have to worry about
the
recapture.
basis comes back up.
Right.
So
Only when you sell for cash.
So those are the two. Got it. So those are the two ways that if I cost seg this building and I depreciate the hell out of it, I either need to die, give it to my kids,
Yes.
or I need to 1031 it when I sell
Yes.
it. Would be the smartest two things to do,
Right.
right? Or just hold on to it for a long time, and you're in the same position as you would be otherwise.
Yep.
Because recapture is a higher tax bracket than paying long-term capital gains. So you don't, if you to your point before of like, if you're not going to hold it a few years at least, you're actually penalized by about an extra 5%, I think, right?
Yes, 5%.
You're paying 25% instead of 20% long-term capital gains on whatever, from what you depreciated down to what your sale price was. So it actually is worse off if you decide to sell and you don't do a 1031 exchange, or you don't roll the funds into something else and then cost seg that, right?
Correct. Right.
Yeah. That makes sense.
And most people, they do 1031 exchanges. Very few people sell a property for cash.
Yep. Do you think the government is going to kind of re-up the Trump tax credits in order to accelerate to the first year again?
You know what? I thought there was a strong consideration they might, but I have not heard anything. I have my ear to the ground and I'm not heard. And by now I would have heard some rumblings.
Yep.
So maybe not. Maybe they're just going to let it play out. So
They'll add it all into at the 11th hour, the week between
Yeah.
Christmas and New Year's before, you know what I mean?
And trying to guess Congress and the IRS, forget about it. You're better off going to Vegas.
Yeah, so let's go through different asset classes.
Okay.
All right, so we went through residential real estate, which is 27 and a half years. You get about 25 to maybe up to 30% on that. Commercial apartments, right? Residential, but 5 units and bigger commercial apartments. Well, what can you typically get on that? 25 to 30 or 30 to 35?
It's a little bit higher, so I'd bump it up 5 more points.
25 to 35, call it?
Yeah, and what does it depend on? You're wondering, well, how am I coming up with this? It's because of the multifamily has a lot of land improvements. Some do. Some don't. I've been in multifamilies where it's an apartment building in the middle of nowhere, and there's nothing. But some of them obviously have clubhouses. They have landscaping.
Playgrounds,
they have swimming pools, tennis courts. Well,
big
then I can
lots.
get 38% on some of those multifamilies.
Interesting.
Yeah.
So yeah, and we're just giving a range, right? Like I just think it's important to understand the tax benefits of this kind of stuff because I utilize it when I'm out raising private money.
Right.
There's a lot of people who are investors and they need the depreciation. They're like, listen, especially right now, one of the things that we're having conversations around is, interest rates are going up. Sellers aren't coming down on price. So it's like we have to get creative and reduce our cost of capital. So one of the ways that we can reduce our cost of capital is raising money and giving these other full-time real estate professionals, giving them the depreciation because I don't need any more of it. Let me give them the depreciation, but then I don't have to pay them a preferred return on their money, right? They still get some equity.
Of course.
That's just based on how well, if they own 40%, I own 60%. They just get 40% of whatever the excess cash flow is. But there's not like, if I had to pay them, I'm buying a $1 million building, right? And I have a bank loan on $700,000 at 7% interest rate.
Right.
And then I have $300,000 from my investor at 10% interest rate. That increases my cost of capital. Versus, I'm buying this $1 million building and I have a bank loan, $700,000 at 7%, and then this other $300,000, if I just give them depreciation, they get 0%. That lowers substantially my cost of capital, my blended cost of capital on that deal, and now I can cash flow deals better than I could before, and I can get into deals a little bit better. So this is like one of those strategies that you have to know because it's an extra tool in the tool belt for you to not only reduce your own tax liability, but structure deals creatively in a way that you can attract private money. Where I got a good friend who is going to write a big check to the government and like $4 million, right? He's like, dude, if you can get me $8 million of depreciation this year, I'll give you my money instead of Uncle Sam.
Right.
And then he's going to get and it's a zero cost of capital, a 0% return that I have to pay him. Other than he's going to get a chunk of equity in an amazing deal that I'm going to buy for $20 million. So that allows him to get equity in a deal that he couldn't have gotten equity into. It allows me to get into an amazing deal that reduces my cost of capital substantially, right? And everybody wins. And it's all within the lines of what the tax code allows and incentivizes business owners to do.
Spread the word for me because there's so many misconceptions.
I'm doing it right here, bud.
I know. That's why I want you to work for me. Come on, sell Cossack.
Yeah. No, I am unemployable, but I will promote the hell out of you because I believe in the strategy for the right purposes, right? I think a lot of people don't understand depreciation recapture, which is why it was really important that we discuss that. Because they just think depreciation, I don't have to pay taxes. It's not that clean. But I appreciate how candid you are about, like, when people bring you a deal and you're like, dude, if you're not holding it, you don't have a tax liability, like these other things, don't bring me those deals because it's not good for you, and it would just reflect poorly on you if you did that anyway.
No, we're upfront and honest. We go through it right away, and I tell everybody, if you're not a good candidate, I don't want your money. Go somewhere else because I don't. I won't take it.
Yeah, let's go buy another building and let me show you how to get depreciation on that one instead. I think that's a very straight up way to do business, and I appreciate that. So, no, man, it's all right. So let's go back to the different asset classes. So we've got residential. We went through multifamily. Commercial is really what starts getting exciting, right? Like, what would you say a hotel or hospitality?
The hotels will definitely not in the 20s. They're going to be in the 30s.
In the 30s.
Because there are a lot of short-lived assets in the hotels. Just a lot. Medical buildings are going to be starting in the mid-30s to high 30s.
So medical and office?
Medical and office. But then senior centers. And I do a lot. One of my clients is in the top 50 of both hotels and senior centers. So I do a ton of both classes. And the senior centers rock too. Because there's just so much of 5-year and 7-year property in the senior. And in some of the senior centers are like huge. They're like 15 acres of land.
Would you say residential assisted living falls into that too?
Yes. Mm-hmm. Sure. Yeah.
So even though it's a residential piece of property, because it's like RAL, where there's like assisted living, maybe some additional equipment or whatever, you can depreciate a bunch of that too. Wow.
And here's a good asset class: mobile home parks. You know why? Land improvements.
Yeah.
A lot of people are going into a lot more into mobile home parks.
Let's talk about mobile homes because I have a lot of people in Legacy Family, my mastermind, our mastermind, right, that are part of that. And let's talk about, you're talking about the land and the land improvements right now. So you're talking about the underground plumbing, you're talking about the playgrounds, the pads.
The driveways.
Yeah.
the landscaping, and then if there's bonus to get, which would be the clubhouse, the pool, the fencing, all of that, is just, it's so rich in 15 year.
What about the mobile homes themselves? Let's assume the landlord owns the mobile homes. Can they depreciate those?
Yes.
In year one,
Yes.
or how?
No, they're just like a regular residential. Yeah, there's no caveat.
So it's 27 and a half years?
27 and a half years, but
Okay.
not a lot in a mobile home. I
Yeah.
mean, am I going to get the normal,
It's because they're like, yeah, you can buy one for $20,000.
Yeah. So,
it doesn't get
if I
too
carve
exciting.
out 25% of $20,000, it's not a home run.
Yeah.
It's the land that gives you the home run.
Got it.
Storage facilities, too.
The next big one is warehouse, storage, flex space, industrial. Talk about what the cost tag looks like on that.
Well, you know what? It's going to be on the lower end. Now we're going to flip it around because a lot of times those sites don't have a lot of land improvements, and that kind of hurts them a little bit.
But I thought the corrugated metal and stuff, I thought you could cost tag that.
It just depends. So here's the deal. What we do is we always, because you might want to know how we set our fee. Well, that's easy to answer because it's engineering time. So bottom line is, we want to look at the building before I quote. A lot of people want me to quote a fee. For modeling, I can do that because that one's set. But for any other type of building, I have to look at it and say, like, I'm here now in Ohio visiting one warehouse, one retail center, a couple multifamilies. I'm doing site inspections now that I'm in Cleveland. And bottom line is, I got to look at the building and see, how long is it going to take me? Mm-hmm. If I'm in the field for 2 days, then it's going to cost you more money.
Yeah.
And that's how I set the fee. How much is it going to cost to go to the field? How much is the engineer going to spend doing the calculations?
But it's time-based. It's not based on a percentage of what you're able to save them.
Guess what? That's against the law. If anybody quotes you that, they're not they're a pretender cost seg company because you cannot charge. It's against the IRS code to charge based on a percentage of tax savings. If I save you $100,000 and I say, my fee is going to be 25% of the 100, it's against the law.
Wow, fascinating. And then let's talk. Which one? Oh, we missed like triple net lease, retail, commercial. What would you say that ballpark is?
Well, then that goes into a wild area with triple net lease because here's the way the leases are written. The way the leases are written, and not all, I'm just taking general, high level, is that when the tenant vacates, all of the inside property goes to the owner of the building.
Yeah.
So a lot of my clients, they take that as it's theirs to depreciate. Now, I'm not saying I agree with that, but a lot of them do. Because let's say a restaurant is full of good stuff. So the building owner, a lot of times will take the improvements and they'll depreciate the improvements.
And that's a little gray area in the IRS's eyes?
I don't necessarily agree with it as they want to take it. So triple net leases are always
You give them the information, they can make whatever decision they want.
Yeah, and I just tell them my opinion and let them make the final decision. But a lot of my clients, they will take those improvements.
Yeah.
And they'll so they can be very rich. You could have a strip center. You can have a triple net. Get you close to 40%.
Wow.
But if you say no, the improvements belong to the tenant who paid for them, then basically you're gonna dent the improvements you can take. So what do I have to work with? The land improvements and the building core. Mm-hmm. There's not a lot in the building core though.
Got it. And then give me a percentage on warehouse and industrial. I don't think we.
Oh, you know what? We're probably going to be between 18 and 25.
Okay. I thought it was. I thought that one was supposed to be more than that.
Just depends.
Okay. All right. Now, do you have to do it the year that you buy it?
No, that's a great question, Tim. I love it. There's the misconception.
Right.
The misconception is, it's too late. The ship has sailed. I can go back about 15 years when you acquire the property.
Wow.
And still make
Where
the math
still
work.
make it make sense.
Where it makes sense. And what do I do? I look at how much my fee is, and I look at how much I can give them in benefit. And what I like to see is 10 times my fee as the value proposition. So if I charge you $5,000, I want you to save $50,000 in taxes. If you don't save it, I'll be the first to tell you don't do it.
Right.
But that's up to the individual, not up to Joe.
Yep.
But that's just my opinion. So basically, if you come up with that value proposition, even if you own the property, you bought it 15 years ago, the math will still work.
I love it. And then one other thing that I heard of, and I have no idea about this. One of my buddies did it, but he bought a beautiful lot with an old house on it. Mm-hmm. And I think he couldn't really explain it that well. I mean, he's like, talk to your CPA, talk to my CPA, whatever. But I think he did a cost seg on a property that he tore down, and then he built a house, a beautiful house on that lot. Can you go into a property, like, can't I, if I'm gonna do substantial renovations to this apartment building in here, can I cost seg everything that's already in there and then cost seg everything that I just put in?
Yes.
Or is it?
Yes, you can do we have many multi-phased reports.
So instead of just tearing everything out and throwing it away, there's tax benefit to having a cost seg done before you do the substantial improvements to the property.
If I can calculate what you threw in the trash, that all has remaining basis or write-off potential. So what I tell my clients that are value add, I want to do
Where
the
you were
first
throwing
things.
it away.
Yeah,
and
you're throwing money.
There's free money there.
Yeah. So I tell them, look, here's what I'd like to do. I'd like to come out there and do the original building first before you throw the stuff away. Otherwise, how am I going to calculate what you threw away? Now, there are techniques I can employ to do it, but the easiest way would be me to get there before you start ripping stuff out.
Which is why people typically want to do it on the front end, right? Like right when you first acquire it, especially if it's a heavy value add.
Mm-hmm. And then I do it I calculate the dispositions, all of the stuff they throw away, and then that's a write-off, and then I'll do it on the new improvement value. So let's say I'll make up a number, $1 million. Now I can go back and cost seg the $1 million.
Dude, I love it. I love it. Mm-hmm. It's so smart. It's amazing, man. I learned a lot. I've done a bunch of cost segs, right? We've done some with you guys, and are going to be doing plenty more. We got a couple big acquisitions that we're in the works on that we're going to be bringing to you guys. So appreciate the relationship, appreciate the friendship, appreciate the insight on this. Give me best words of wisdom for somebody watching this. Like, what's kind of an action step that they can take in order to learn a little bit more about this, connect with you on it, or like, I don't know, maybe audit their portfolio?
No, what I tell folks that have a portfolio, give me everything. I will at no charge give you the keys, and you can see how much it's going to cost and the benefit. Then you go back to your team and you say, what are we going to do in 23? Because if you can't use all the depreciation, it follows you forward until you use it all up. So it's not going to go away. Mm-hmm. So what I'll do is I say, you pick and choose the properties you want to do. You pick and choose your strategy. I don't care. If you want to do them all this year and get 80% bonus, do them all this year. Mm-hmm. If you want to do them chunked out, 10 this year, 10 next year, 10 the next year, do it that way too. Mm-hmm. And I don't charge to do that first step. That's a no-cost estimate.
I love it. I love it. So that way you can at least take a look at everything, give them a ballpark. Maybe they want to do some of them, maybe they don't want to do other ones, and then understand what the financial implications are positively, right, by taking it to their CPA.
Now, there's one thing we might want to talk about is just touch briefly is the energy tax credits.
Yeah.
Because you mentioned value.
Let's talk about that.
You mentioned value add.
Okay, so cost seg, super informative. I love this, by the way, and I'm gonna have my business partners watch this and my CPA and make sure that you guys are all on the same page on this stuff. And but the other thing is, and you touched on this at the very beginning, but you guys do energy cost savings and tax savings. Tell me what that's about. I know we all hear about this, but I don't think people really, I don't really understand it, so I'd assume other people don't really understand what that does and how that can benefit us.
Well, this is for value add property people, property owners. If you know you're going to go in and you're going to do value add on a property, are you going to increase the energy efficiency? Well, come on. If you're going to do value add, what are you going to do? I can name the usual suspects.
Yeah.
You're going to put in maybe, not all, but you're going to put in new HVAC. You're going to put in a new water heater. You're going to put in new lights. You're going to put in LED lights. You're maybe going to put in new doors. You're going to put in new windows. You're going to put in new insulation.
Toilets, all of it.
Guess what you've done? Toilets, appliances. You've now increased the energy efficiency of the building. There is a tax credit out there for that.
So
and you can go back 3 years to get the credit.
So depreciation, if you make $1 million a year and you have $300,000 of depreciation and your tax liability is 30% of $1 million, let's call it, if you had $300,000 of depreciation, it would reduce your earned income tax, your earned income,
to
gross
$700,000.
income, to $700,000,
Right.
and then you pay taxes on $700,000.
On the remaining balance, correct.
Right. Where a tax credit comes in is if you earn $100,000 of tax credits, it doesn't reduce your gross income. It reduces your tax liability.
Yes.
So on that $700,000, if you have to pay 30% on that, let's call it $210,000, you're offsetting 100 grand of it
Yeah.
with a tax credit, so you really only have a tax liability of 110.
That's good. That's
You
it.
want tax credits even more so than you want write-offs and depreciation.
So now, how does an energy tax credit work? Well, basically, if you first of all, it's very complex. So what happened was, prior to September, is that every year they enacted it. So nobody wanted to do it because Congress would drag their feet. So it would be a whole year before they said, oh, you can take it last year. And nobody wanted to do it. They didn't want to pay to do a study and then find out that the Congress said no. In September, they made it now a 10-year part of the code. And there's a lot of little changes to it. But so bottom line is now you don't have to wait every year. It's
So this is part
there.
of the whole solar piece too, right?
Yes, it's
Yeah, okay.
all connected. But
Because it was about to go away, and then
Yes.
they just put another 10 years of runway on
Yeah.
it.
So you not only have the solar piece, which we're not involved in because there's a lot of advantages for solar, but what we are involved in is my energy engineers will be looking to see if you've met the 2006 level, if you've increased your energy efficiency by 50% over that level. So what do? We just need to know what you did for the building. And this is the hard part, because a lot of the builders out there, people who do the renovations, maybe don't know this. So we need to know, what's the rating of your insulation? What's the SEER value of your air conditioner? What kind of water heater did you put in? What kind of lighting did you put in? If you can get us that information at no charge, my energy engineer will tell you if you're going to qualify. But here's the big value. If you're a builder of property, take advantage of this before you start building your property. Talk to my engineer and say, what do we have to do? You don't have to do it before, but at least you're going to get an idea of what you need to do. Because if you put a 13 SEER cheap-ass HVAC, you're not going to qualify.
So you would also say, hey, go and check out this one or this one or this one. Yeah, hey, you might spend an extra $300 per HVAC, but the reality is, because you can now get this tax credit, it's going to save you a boatload of cash.
Yeah.
Now, when you get a tax credit, do you have to pay that back? Is there anything?
Nope. That's a pure tax credit. And here's the miracle. Remember flippers, we said because of the depreciation recapture, unless you hold the property for 2 years, don't do it. You can go back for 3 years. If you're the flipper and you did that on your property and you sold your property right after that, you can go back and claim those tax credits. Woohoo! Now I've got a product for the flippers out there.
And there's been a lot of them that flipped a lot of houses over the past 3 years. So
now, I
if
still
you're
need the information.
transacting real estate, yeah, I mean, obviously you need to go back to your receipts. You got to look up, I would think makes and models of all the different equipment that you installed. But if you have access to that stuff, like that's a big deal.
So here's what the new from 23 forward is. It took the old number, which was 2,000 per door. So that's set in stone. If you did something 3 years, you're going to get 2,000 per door. So multifamily, you have 100 units, you're going to get 200,000, right? 2,000 per door.
But that is based on, like, how do you get to that 2,000?
Well, no, that's the tax credit if you do the work. If you've increased the energy efficiency to those standards, you're going to get the 2,000 per door.
So what if I did, light fixtures and faucets and toilets and insulation, but I didn't do windows? Right? Can it still meet the standard?
It can. It can. The easiest one would be if you bought a new HVAC and you bought a 14 SEER HVAC, I can almost guarantee that you just didn't buy an air conditioner. You probably did something else, and you most likely are going to qualify.
So just that one
Yes.
puts you pretty much 90% there, and then everything else would fall into place.
But if you didn't do that, let's say that now you're talking about windows.
I mean, we standardly do low flow fixtures, faucet, toilet, shower head, LED lights everywhere.
Right.
And typically we always do windows. Do you think that would get me pretty much there?
Pretty close.
Okay.
See, here's here's what people I made it a little bit more complex because you really can't go into too many stores or arenas in the United States without buying energy efficient stuff.
It's all standardized.
They just don't
right?
sell it anymore because it's against the code. So most of the time you are buying it, you just don't know you're buying it, but you are. But I have to know what you're buying. and then we'll come back and we'll tell you if we think you're going to qualify or not. So you get a $2,000 per credit for tax year 22 going back to 19, so going back those 3 years, and then going forward, it bumps up, and it's complicated, but it bumps up between $2,500 and $5,000.
Wow.
Now you get into the weeds because you're talking about, you
get partial credits?
No.
No?
No, you either qualify or you don't.
Got it.
But it depends on a lot of factors involved, like Energy Star ratings and all that stuff. My engineer is the one that's going to talk to you. I can't talk to you on that, but to get to the $5,000.
Yep.
But let's say that you have a multifamily. Now you're getting $5,000 per door. Now, what's it going to do?
Money.
That's going to not only increase your cash flow, but then it's going to increase the value of your property. So that the money you're going to get to in return is not just the credits, but there's all kinds of value.
Well, a property's valued, an income-based property is based on the income approach. So it's income minus expenses equals the net operating income. And when utility expenses are going up, when interest rate expenses are going up, when taxes are going up, insurance is through the roof. Like, you need to start looking at different ways in order to reduce your expenses. And one of them is easy with the energy efficient stuff. How do you reduce your utility costs? Well, you put energy efficient appliances in, energy efficient light bulbs, LED light bulbs, and low flow toilets. Like, we've been able to reduce our water by almost 40% because we put low flow fixtures in, right? We're able to reduce our light bills by about 15 to 25% depending on the building, because we do all LED fixtures and lights. You know, like, just by doing that stuff, it reduces the expenses, which goes straight to the bottom line and then increases the enterprise value and the multiple of the property.
But here's the answer to your question you asked before. My key, words of wisdom, get a team. Not professional, get help. So in other words, get a Tim Bratz on your team. Get other legacy members on your team, because real estate, there's so many different ways you can go, even with taxation. So you need to have valuable advisors. Do not use, this is my opinion, do not use the accountant whose base is all people who work for Costco. You want an accountant who knows real estate. So my suggestion is join a legacy.
Agree to hunt for that.
Talk to your peers. Collaborate with them. That's my suggestion.
I agree 100%. I think I've had actually multiple conversations this morning with people just on the phone, and that changes everything, right? Like, if you hang out with a round crowd that doesn't know what they're doing, and they're going to H&R Block, or they're going to the Sam's Club or whatever, and having their taxes done there, that's the result you're going to get, right? If you're hanging out with high-level people, like, it comes back and will pay dividends many times over if you're having these kinds of conversations. Things that you weren't even aware of are now available to you. Well, Joe, dude, it's been so valuable sitting down with you. Tons of great insights, man. I'm excited to send you some of our cost seg stuff, and excited that you're part of Legacy family, and I'm excited to watch your course in Legacy Wealth Academy.
Tim, it was a pleasure being here. You offer a great mastermind, and I love the work you do. So appreciate it, man. Yep.
Awesome value, so much insight. Hopefully you took notes, and specifically share this with your tax advisor. Like, share it with your CPA, share it with your attorney, share it with your business partners. So that way they can understand what you're talking about and what you're looking to accomplish if you do reach out to Joe and do some business with him. And by the way, I don't get anything. Joe's part of our community, part of our mastermind. He's an absolute rock star and great guy, and is very well regarded in the industry. And so that's why I like putting people like him on Spilling the Beans and sending business his way, because I know he does the right thing, and I know he does it at a high level and at a high quality. So reach out to him. Again, I don't get anything from it, but that way your CPA understands what he's talking about. They can get connected and find the who to do the what, right? Find the who to do the how. That's the key here, is connect the pieces. You, as the CEO of your business, should be the person who puts the puzzle pieces together and lets them kind of handle everything from there. And then you keep on building the business that way. So I think it's an amazing resource to understand and realize that it's a tool in your tool belt that you can utilize as you continue your investing career and as you continue to grow your businesses. So appreciate you being here. If you got some good value, please like, share, subscribe to the channel. Give me your biggest takeaway in the comments below. Share this with somebody else who might get some good value out of it. And I will see you next week on Spilling the Beans.